What is a T account? A T account is an informal term for a set of financial records that use double entry bookkeeping. The term describes the appearance of the bookkeeping entries. First, a large letter T is drawn on a page. The title of the account is then entered just above the top horizontal line, while underneath debits are listed on the left and credits are recorded on the right, separated by the vertical line of the letter T. A T account is also called a ledger account. Understanding T account. A, double entry system. Every transaction affects at least two accounts, one with a debit and one with a credit. B, general ledger. All these transactions are recorded in the general ledger, and the T account is a visual representation of individual accounts within that ledger. C, structure. The T shape clearly separates the account title, debits is left, and credits is right. D, purpose. It helps accountants visualize and organize financial data to maintain balanced books. Example of T account. If Barnes & Noble Inc. sold $20,000 worth of books, it will debit its cash account $20,000 and credit its books or inventory account $20,000. This double entry system shows that the company now has $20,000 more in cash and a corresponding $20,000 less in inventory on its books. Account recording: 1, assets. A, debit, the increase. B, credit, the decrease. 2, liabilities and shareholders' equity. A, debit, the decrease. B, credit, that increase. The example of issuing shares for $100,000 is a great way to show how this works. Asset account example: cash would be debited by $100,000 as increase. Equity account example: common stock would be credited by $100,000 is increase. This maintains the fundamental accounting equation: assets vs liabilities plus equity. T account advantages. A, clarity for adjustments. When you need to adjust an account example recognizing accrued expenses, deferred revenue, depreciation, the T account provides a clear visual space to record these changes. You can easily see the pre-adjustment balance and then apply the debit or credit needed for the adjustment. B, matching principle. By using T accounts to make adjusting entries, accountants can ensure that expenses are recognized in the same period as the revenues they help generate. For instance, if you've used up a portion of prepaid rent, you can credit the prepaid rent asset account and debit the rent expense account to reflect the expense incurred during the period. C, balancing act. The T account format inherently emphasizes the debits and credits, making it easier to verify that every adjusting entry maintains the fundamental balance of the accounting equation.